Hello, financial enthusiasts! Welcome back to Stock Market Callus, where we reveal the secrets to financial success and building a solid foundation for a brighter future. Trading is not a one-size-fits-all endeavor. Traders employ a variety of strategies and styles based on one's beliefs and knowledge of the markets. What works for one trader may not work for another, which is why we have a vast array of trading processes in existence. In this video, we aim to introduce you to various types of trading approaches. We'll be exploring different trading strategies, time frames, analysis techniques, and asset classes. Our goal is to help you gain a comprehensive understanding of the trading landscape and equip you with the knowledge to make informed decisions. Whether you're a beginner looking to explore different trading styles or an experienced trader seeking new insights, this video is your ultimate resource. We'll be breaking down each trading approach, providing real-life examples, and discussing the pros and cons of each strategy. So, let's dive right in. To become a proficient trader, you must first develop a robust trading strategy. This involves setting clear goals, identifying your risk tolerance, and formulating a plan to enter and exit trades. Without a well-defined strategy, you're simply gambling with your hard-earned money. We have two popular trading strategies: momentum trading and mean reversion trading. Momentum trading focuses on stocks that are experiencing strong price trends and significant volume movements. Traders aim to ride these trends and profit from the continued momentum. They look for stocks that are moving in a particular direction with force, typically over a specific time period. The key principle is to buy stocks that are in an uptrend and sell stocks that are in a downtrend. While this strategy has a lower probability of success, it offers the potential for significant profits if the trend continues. On the other hand, mean reversion trading operates under the belief that stocks that deviate from their historical average price will eventually revert back to that average. Traders using this strategy take advantage of price deviations by buying when the stock is below its average and selling when it's above. The goal is to capitalize on buying low and selling high. It's important to remember that these strategies have different characteristics. Momentum trading has a lower success probability but a higher profit potential. Mean reversion trading has a higher success probability but may result in smaller profits. Moving on, there are different trading approaches based on time frames. Let's explore four popular ones: scalping, day trading, swing trading, and positional trading. Scalping involves making quick trades throughout the day to profit from small price movements. Traders take advantage of small profits from each trade, accumulating them over time. It requires quick decision making and monitoring of the market closely. Next, we have day trading. Day trading involves buying and selling financial instruments within the same trading day. Traders aim to capitalize on short-term price moves and close all positions before the market closes. It requires careful analysis and managing multiple trades in a limited time frame. We also have swing trading. Swing trading focuses on short-term strategies in liquid stocks or indices. Traders aim to benefit from price swings, whether reverting back to the medium or fading a rally. Swing trades typically last from a few days to a few weeks, allowing for medium-term market fluctuations. Positional trading involves holding trades for longer durations, ranging from weeks to months or even years. Traders analyze macroeconomic factors and industry trends to make informed decisions. It requires patience and a broader understanding of the market. Each trading time frame has its own characteristics. Scalping and day trading offer quick trades, while swing trading allows for short-term analysis. Positional trading focuses on long-term market structure. Traders can choose the time frame that suits their preferences and trading style. Another three prominent approaches to trading are through analysis techniques, which include technical trading, fundamental trading, and techno-fundamental trading. First up, we have technical trading. Technical trading involves analyzing charts and graphs to identify patterns and trends. Traders use historical price data and indicators to predict future price movements and make informed decisions. Moving on, we have fundamental trading. This style is based on fundamental analysis, which focuses on examining various factors beyond price action. Fundamental traders delve into corporate events, earnings reports, stock splits, and other factors that impact the intrinsic value of an asset. Fundamental analysis allows traders to assess the financial health and prospects of a company or asset. By understanding the fundamental factors that drive the market, fundamental traders aim to make trading decisions based on long-term value and market trends. Finally, we have techno-fundamental trading. This approach combines the best of both worlds, technical and fundamental analysis. Techno-fundamental traders conduct a fundamental analysis to shortlist potential stocks based on company prospects and industry trends. Once the shortlist is created, techno-fundamental traders employ technical analysis to determine strategic entry and exit levels. They consider indicators, chart patterns, and other technical tools to time their trades and optimize their potential for profit. Regardless of the analysis technique you choose, risk management is paramount. Setting stop-loss orders, managing position sizes, and conducting thorough research are essential to protect your capital and make informed trading decisions. Finally, let's dive into the world of different asset classes in trading. We'll be exploring 5 prominent categories: equity trading, derivative trading, currency trading, commodity trading, and crypto trading. So, let's get started. To begin with, we have equity trading. This involves buying and selling company shares or stocks on the financial market. Equity trading typically takes place through a stock exchange or as over-the-counter products. Traders focus on the value and performance of individual companies, aiming to profit from price movements in their shares. Next, we have derivative trading. Derivatives derive value from an underlying asset, such as stocks, currencies, or indices. Derivative traders buy and sell these financial instruments in the stock market. Derivatives allow traders to speculate on the future price movements of the underlying assets, offering opportunities for larger speculative bets. Moving on, we have currency trading, also known as forex trading. Currency trading involves buying and selling currency pairs. Traders speculate on the relative value of one currency against another. For example, euro or US dollars represents the value of the euro against the US dollar. Forex markets are open 24/7, providing traders with constant trading opportunities. Now, let's talk about commodity trading. Commodities are widely traded assets categorized into metals, energy, agricultural, and livestock sectors. Traders can buy and sell commodities such as gold, crude oil, corn, or live cattle. Each category offers unique trading opportunities based on supply, demand, and market trends. Lastly, we have crypto trading. This relatively newer asset class involves speculating on the price movements of cryptocurrencies. Traders can either speculate on prices using contracts for difference or CFDs, or buy digital currencies with the hope of selling them at a higher value. Crypto trading offers unique opportunities in the evolving world of digital assets. Regardless of the asset class you choose, through research, risk management, and staying updated with market trends are crucial. Traders must understand the unique characteristics of each asset class and adapt their strategies accordingly. And that's a wrap for today's video on trading strategies, time frames, analysis techniques, and asset classes. We've explored the exciting world of trading and covered the numerous strategies that traders use to navigate the markets. Remember that trading is a dynamic process that involves continuous learning, adaptation, and risk management that is disciplined. It is critical to experiment with various strategies, time frames, and analysis methodologies to determine what works best for you. We hope this video has offered helpful information and piqued your interest in learning more about trading. Remember to conduct thorough research, stay informed about market trends, and always trade responsibly. If you found this video useful, please give it a thumbs up and subscribe to our channel for more trading and investing information. We're here to help you along your trading path. Thank you for joining us today. Keep learning, keep trading, and until next time, happy trading!
Our trap is done